SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Let me welcome all of you to this SUERF-BAFFI Bocconi e-lecture on key takeaways from the ECB's May 2026 Financial Stability Review. Listening to the contents of the FSR is, of course, always very interesting. I think at this point in time, it is probably even more interesting than it is otherwise. Why is that? Well, obviously, the outlook is challenged by a series of geopolitical shocks and risks. And against that background, it's probably not a surprise that the FSR hit the FT's headline actually already this morning. So maybe John will tell us a little bit more about this. There's many things on the mind of financial stability people. The further energy market disturbances that would negatively affect growth, inflation, and the interest rate outlook is, of course, a very important one. Now, the good news is that banks, they exhibit remarkable resilience, and this is mostly due to the past buffer buildup and the healthy profits that they had in recent years. But other financial market segments may be a little less resilient, and they're certainly also less transparent, and hence possibly more prone to financial risks. Now, we have a lot on the plate today, so let me welcome the speakers today. First of all, we have the lead presentation by John Fell. John Fell is Deputy Director General in Macroprudential Policy and Financial Stability area of the ECB. He's also a SUERF Fellow. And I had the pleasure of working with John for a couple of years. And so I know on first-hand experience that he's really the mastermind between the FSR and many editions of the FSR. His presentation will be followed by comments and further inputs by two excellent financial stability experts. A very warm welcome to Katja Taipalus. Katja is the head of Financial Stability and Statistics Department at the Bank of Finland at Suomen since 2015, so already more than a decade. And under this department, there are, among some divisions, the Financial Stability Macroprudential Analysis Division and also the Macroprudential Policies Division. So excellent. Last but certainly not least is Fabio Natalucci. Fabio is a CEO of the Andersen Institute for Finance and Economics. Now, Fabio has been also in this business for more than 2 decades, focusing on global financial market and macroeconomic policy analysis. So among things that he has done, I think it's most notable that he served as Deputy Director of the Monetary and Capital Market Departments of the IMF, where he was overseeing the Global Financial Stability Report, which is a bit of the global pendant to the ECB's FSR.
Thanks a lot, Reiner, and thanks to you, to Ernest, the SUERF board for inviting us again to share the findings of our latest FSR, which was, as you mentioned, published this morning. I always say it, but I'm going to say it again because we greatly value these opportunities, not only for sharing, but also for hearing the valuable feedback of the discussants. And we've got some really great discussants today, and I'm looking forward to hearing what they have to say. And also the colleagues who joined these webinars. I mean, we find it useful also to hear not only comments on this issue, you know, what we missed, what was good, what wasn't, but also ideas for the future. To set the scene for this presentation, our recent reviews have been written against the background of a notable shift in how markets are viewing artificial intelligence. So for most of last year, I think the question was, and it certainly peaked around the summer last year, whether the hyperscalers could ever recover the capital that they were sinking into AI infrastructure, and whether stretched equity valuations and tight spreads on lower tier corporate credit were symptoms of a quietly inflating AI bubble. Now, by early this year, I think the question started to change. It became whether AI was already leaving disruptive footprints, and first signs were visible in business models like software but maybe also in employment data. And of course, I think the pockets of vulnerability in private credit, and where private credit has been a source of finance for some of these software firms, I think that has really brought to light, why this disruption could be a financial stability issue. Now, that shift may, I think that may ease one concern, because if you've got, there is this substitution taking place, well, maybe that raises the probability that AI will actually recover the investment for the investors. But it does raise another issue: general purpose technologies. We know we don't see these big technological transformations too often, but when they happen, you get winners and losers. And for financial stability, I think the issue, it's not that that we know that there will be losers, but it's that some losers may lose abruptly, and that leverage and opacity can amplify the losses far beyond the firms that are first affected. In a way, I don't know whether it's exaggerated to say it, but the tectonic plates may be moving, and we know what happens, when they meet. Now, onto this backdrop, we're all too aware that an acute energy shock has now landed, and the closure of the Strait of Hormuz, it severed a key artery for global oil and gas. You see it there in the chart on the left. Ship traffic collapsed, and then we have consensus inflation forecasts for this year have shifted up. Growth has revised down. I mean, the hallmarks of a supply side shock, and then market implied policy rates are higher for both the euro area and the US. And I guess we are now dealing with two potentially colliding forces. So we've got AI disruption and an energy shock. Now, we know that geopolitics is behind much of this. We don't get into that in too much detail in the episode. Our focus is more on analyzing how those shocks may interact, and especially how they may interact through valuations, through credit, confidence, and also balance sheets. So you go to the next slide, and against this backdrop, as usual, we've organized, we always do this, we try to organize the episode around three themes. Usually they're a bit intertwined. I mean, I think this time they're maybe more intertwined than usual. The first is that we think prolonged geopolitical tensions and lingering fiscal challenges could derail market sentiment and unearth sovereign vulnerabilities. Second, our analysis suggests that vulnerabilities among non-banks, non-bank financial institutions, and particularly those that are tied to private markets, could amplify stress in financial markets and increase the risk of cross-sector spillovers. And then third, and this is really the balancing item in the assessment, we note that overall, and you said in the introduction, Reiner, that overall banking resilience has strengthened further. But we still see some vulnerabilities, credit, funding, and liquidity vulnerabilities we think might still unravel, and given exposures to non-bank financial institutions and to energy and trade sensitive corporates. Banks are quite exposed to a number of the different things that we're worried about in this issue. So I'm going to go through each of these in turn, and if we can just go to the next slide, just one orienting observation to make before we start. Reiner, we were discussing this last year, I think almost exactly 1 year ago at the SUERF conference on communication. And we have, in the meantime, built an AI sentiment tool. It's described in special feature A, and we've extracted the overall tone of each issue of the FSR since 2004. So it's 43 issues in total. This is the 44th issue. We don't have a data point for this issue because we felt we didn't want to share in advance the findings with the AI tool that we're using. But what you do see there is a dot, which is based on an extrapolation, a model that fits this sentiment indicator relatively well. And I think what stands out there is the negative sentiment in this issue is more pronounced than in any recent edition. Now, it's not reaching historical extremes, but it is approaching levels preceding the global financial crisis, the sovereign debt crisis, the pandemic, and also the 22 energy shock. But I mean, that said, I don't want to create drama out of that message, because it doesn't mean that we are saying that a crisis is around the corner. But I think it's consistent with our broader judgment that vulnerabilities are elevated. And I think it's also a bit of vindication of our financial stability approach, which has always been about identifying the vulnerabilities. It's the vulnerabilities that matter when shocks come. And I think the pandemic, for instance, really showed that. It wasn't something that you could have predicted, but our indicator, as you can see, was actually indicating that vulnerabilities were high. So the system was vulnerable to shocks. And that's a bit the situation now. So we go to the next slide and turning to the first theme. Two forces have shaped financial markets since our last edition. At the start of the year, I'm going to say software related and large cap tech names were falling. Their stocks were falling sharply on concerns that frontier AI models were beginning to substitute for rather than complement existing business models. The left chart captures it. I mean, you see it in software, in AI indices, but and at the same time, energy was moving the other way. Then everything changed. The war began. The right-hand chart compares the response of European sectoral stock indices with the response to the Russian invasion of Ukraine. There are similarities and differences. Energy, defense, and health outperformed, as you would expect. But I think the breadth of the equity decline. We think there's information content in that more than the size of any single market movement. The shock basically landed across virtually every cyclical sector, across the main indices, and also against the dollar. So markets initially, I think, were pricing in a short, contained event. And yeah, I mean, I think the breadth of the movement kind of tells us that. But then we had the second wave, and by then they were no longer doing so. Now, I think an obvious explanation here is that awareness spread quickly that a sustained rise in energy prices could also weigh on the AI narrative, because AI infrastructure is highly energy intensive. Think data centers. So the two shocks are colliding for some sectors. And I think once again, I mean, we've had this in several issues, emphasizing the importance of taking a sectoral, economic sector perspective in our assessment of sources of risk. Now we go to the next slide and staying with this, still with this first theme, but moving here now from sentiment to fundamentals. The left panel here is showing equity and bond valuations, and even after the March adjustment, you can see from the position of the blue diamonds on those charts on the left-hand side chart, they were mostly hovering well above their long-run distributions. Forward price earnings ratios for world and also for US tech equities, you can see they're now sitting here more or less at the top of their 20-year ranges. And then on the right of that chart, on the right of that left-hand side chart, here lower figures mean higher valuations, because now it's about spreads, investment grade and high yield. Those are at the bottom of the chart. So, I mean, I think at the very minimum, we can say that assets are not priced for bad news. Now we have the volatility panel in the middle. It's a bit striking, but in a different way, with the exception of commodities. Volatility across interest rates, equities, foreign exchange, and credit, they remain near or below historical norms. So we have an unusual combination: high valuations, compressed risk premia, but rather low volatility. We've had this for some time, but we didn't have it against the background of an acute geopolitical shock. Some people describe this as cognitive dissonance, where there are absolutely two opposing forces, and you're going to give on one or the other going forward. I think we think that configuration makes markets vulnerable to negative surprises. Now we move to the right, sovereign bond markets. These are, of course, we view these as central transmission channel spreads of other euro area issuers against Germany. Despite recent upticks, let's say, they've remained narrow and much narrower than maybe they would have done 15 years ago. Despite some early diversions after the outbreak, and the market, I think, has overall remained resilient. But we have been stressing, of course, that there are fiscal, the more traditional sources of debt dynamics and so on, whether or not, we're going to, whether they're stable or not. But there are new pressures lurking beneath the surface as well that we think are important to take account of. One of them is that the investor base is changing. We mention Dutch pension fund reform, which has reduced long-end demand. But at the same time, ECB had been a big participant in the market. It's not any longer, and we have global hedge funds becoming much more active in euro area sovereign markets, including in leverage basis trades. This is all detailed in box 2. But the important point is, and I think maybe I said it the last time, I mean, for those who have been used to kind of quiescent sovereign bond markets, bear in mind the participants. We have more news-sensitive market participants in sovereign bond markets than we had in the past. And that probably means that we're going to see more responsiveness to shocks than we've seen in the past, and maybe what people are used to. The other lurking in the background is, well, it's maybe not so much lurking in the background, but it's a well-known, it's an unknown risk of spillovers from concerns about US fiscal credibility and in other advanced economies. So I think here, resilient markets that we've seen, it doesn't provide any ground for complacency. We don't think it's necessarily a guide to how resilient markets might be in a more stressful scenario. So that completes the first theme. We can go to the next slide, and this is taking us from valuation to potential for amplification. So this is the ever-recurring question of whether the non-bank sector, again, I mean NBFI, non-bank financial institution sector, could turn a market movement into a market problem. The pair of charts here show fund flows in the weeks around the outbreak of the war in the Middle East. And one might also almost say that the pattern is pure textbook flight to safety. We just one twist, an inflation twist. Sovereign bonds attracted strong inflows, high yield corporate bonds shed assets quickly, and there was also a marked shift towards inflation protected and short-term funds at the expense of long-term bonds. So we note in another point that I think was important about all this flow that was taking place, something a bit unusual, is that retail and institutional investors were moving in the same direction at the same time. We don't often see that, and I think it's worthy of note because it does imply that less kind of natural offsetting within the system. So far, these flows have been absorbed without disruption, but we do think the conditions are in place for pro-cyclicality, amplification. Margins on interest rate derivatives have already risen with the upward shift in interest rate expectations, and that adds to the presence of some of the other well-known structural vulnerabilities that I've mentioned in previous SUERF seminars in the sector, which are capable of amplifying market adjustments. Now that means we think a renewed bout of correlated price moves across bonds and equities of the kind that we saw in March. We think it could trigger margin calls in a further round of redemptions from riskier funds. I'll go into the next slide a bit more, just reminder on those vulnerabilities, but showing things in a slightly different way. This slide deepens on the same point. We've got two pictures here. The left panel tracks the cash holdings of euro area investment funds against the VSTOXX volatility index over a relatively long period of time since 2015. The almost continuous decline of cash buffers is striking, and we have been reporting it every single issue, I would say. And even recently, if they could not even get lower, they did, and we still get continuous decline. I mean, in numbers, bond fund cash holdings have fallen from around 6% in 2020 to around 4% now. Equity funds, it's basically halved from 4% to 2%. And you can see, I mean, I think what I like about this chart is the message, this message that we always say, you could have situations where funds are forced to sell assets. That happens when they don't have enough cash. And you can see it did happen there on the chart. You've got the yellow line going through the blue line. That was a moment of forced selling. So sell what you can. And then the right panel, you can add some color to the asset side. Non-bank portfolios still contain again, this is non-bank financial institutions. They still contain concentrated exposures, particularly to US equities, and within that to AI-related assets. And we think the valuations of these assets are, I mean, in general, stretched. I mean, priced for perfection. At the same time, those holdings are heavily denominated in US dollars. Now, we were hearing a bit more that there was some hedging going on, but we don't think it's perfect hedging. So that means that euro area non-banks are kind of doubly exposed to US equity valuation moves, but also to swings in the euro dollar exchange rate, which has been moving a bit more maybe than we have been used to. And just to give a, I don't know, kind of a ballpark figure for how big the impacts can be. We did an estimation of, I mean, what happened last year with the depreciation of the dollar. We think it led to about 150 billion of valuation losses. Okay, there were paper losses on US equity holdings; they were reversed, but still, those losses become real if funds have to sell assets. So they have to. They're forced to take the prices. We go to the next slide, and with this same second theme, now we move into kind of topic du jour, private credit. I mean, it's hardly a day goes by that you don't see an article in the FT or elsewhere about on this topic. So we felt we should dig into it a bit more. The details are we have a special feature on this topic. I can't really do the analysis justice, but I think first the left chart here puts numbers on what the headlines have been all about. It shows redemption requests made by investors to so-called to US business development companies, BDCs. And since the start of the year, these have risen sharply, partly on software and AI substitution concerns, partly on broader credit quality concerns. And then importantly, as you can see there from the blue bars, they're not reaching the height. The dark ones are not reaching the height of the lighter ones, and that means that only the redemption requests are only being partially honored. Now, of course, that's the signature of redemption gates at work, and not only that, it's redemption gates that are working. So, I mean, it's not necessarily a bad thing, but it does show that there are pressures on BDCs, are real, and they're testing the liquidity arrangements of these vehicles. For the euro area, direct exposures are limited, and I think this is one of the main reasons why we don't think that this is a systemic risk for the euro area per se. But the exposures are not zero, and there are important indirect channels which, while dormant now, they could spring to life in a different state of the world. So the right-hand side chart sets out kind of a stylized three-stage simulation that we did in the special feature, where we have 3 stages of cranking up stress. Starting in a stage 1, where it's confined only to a private credit shock, and then there the impact is really modest, and then the stress is cranked up in stage 2 with the addition of a spillover into leveraged loans and high yield bonds, where software exposures correlate, and these are of course maybe some of the closest substitutes for private credit type assets. And then with more stress still in stage 3, and here what we do is we have a 30% equity market decline, and then we also have forced outflows from high yield bond and open-ended private credit funds. And then at this point, this is where we start seeing serious losses. Valuation losses for insurance companies and pension funds start then to run into the high hundreds of billions of euros figures, equivalent to several percent of their total assets. But we think that is only happening in a very low probability scenario. So, I mean, I think when we say that private credit, we don't think it is systemic. It's a conditional statement in isolation. But the answer would change, taking fairly severe confidence effects, spillovers, etc., into account. But go to the next slide, and the third theme. This is where risk transmission becomes most important, and where we try to, this is really where the balance of the assessment comes in. So the starting point on resilience, I mean, you said at the beginning, so just a few figures: return on equity for the banking sector averaged close to 10% in 2025. core equity tier one ratios are at a new high. Really impressively, I think, is the aggregate NPL ratio is still unchanged at a historical low of 2.2%. Reiner, you and I worked on NPLs. We don't remember numbers as low as that. You know, it's impressive. That's the aggregate number for the euro area now. Liquidity coverage ratios still are sitting well above requirements as well. And then we're now able to say that every banking union country, and this is different to pre-COVID, every banking country now has some form of releasable capital buffer in place. And so that means that banks, you know, because of that resilience, were able to navigate the early months of the war pretty well. And we think the starting point for addressing, you know, being confronted with new shocks is also pretty good. But we do think that there are vulnerabilities, and they're partly obscured by the aggregate figures. First, the middle chart. I mean, just looking at the Middle East is a question we get a lot. I mean, what are the exposures to the Middle East? They're small, around 0.6% of total assets. The more important channels for the fallout of the war really are second round ones. So through the macro-financial channels. And the right-hand chart maps euro area firms by trade reliance and by energy intensity. Manufacturing, electricity, wholesale and retail are all sitting up at the top right, and they are not small sectors. High reliance on markets and inputs and high energy intensity is up in that top right-hand quadrant. And then we think a prolonged shock here would most likely work through bank balance sheets via asset quality deterioration in these sectors. And I mean, I think we are already beginning to see some emerging vulnerabilities in, for instance, German SME loans. And third, I mean, I have to admit that this is a bit, you know, becoming more of a kind of Cassandran point, but I mean, it's something that could become relevant in a more stressful situation. On the left, on aggregate, banks are net debtors to the non-bank financial institution sector, and a material share of that funding is short term. So a non-bank financial institution liquidity shock of the kind analyzed in the previous team, I mean, the one where we get to stage 3, say, you know, maybe that could also unleash pressures on bank funding through overnight deposits, the repo market, etc. And I mean, I think that also helps to, you know, I said at the beginning that there was interlinkage between the teams. They're not independent, and I think that they are linked quite a bit through this non-bank financial institution nexus. Vice President said it earlier today that the NBFI now is becoming the sector as a whole is becoming the most important client of the banking sector. So we really need to keep an eye on this linkage, and it is a big focus in this edition of the FSR. So that brings me to the policy messages. I mean, this is a bit repetition. The implications are not new. It's the next slide, but they read somewhat differently, I think, against the backdrop that I presented. Can we move? Can we go to the next slide? So for banks, the message is, I mean, we said this before, to maintain the releasable buffers that have been built, resist pro-cyclical pressure to relax capital requirements, which of course comes when, you know, capital is in the great place that it is in now, and then to continue the simplification agenda without compromising resilience for the banking sector. And then for non-banks, mostly not a new message either. It's to implement the internationally agreed reforms on leverage and liquidity, advance the macroprudential framework for asset management at the EU level. And I think the new bit maybe is, well, we said this in different contexts at different times, but closing the data gaps, because I think this is where, particularly for private credit, opacity has been a big part of this. I mean, I think there's one of the issues is it's very hard to analyze private credit because there is a lack of data, and you know, to do that kind of stress test that we did, yeah, and to do it in a okay. I mean, we're comfortable with the numbers, but we think we could do even better with better data. If we go now, I'm going to close with the next slide, returning to the 3 themes, and just underscore some of the main messages. Sovereign and market sentiment are under strain. We think that there is potential for non-bank amplification coming from a number of different channels, and then bank resilience, while it's great, it might come under second round pressure. And then I think these 3 themes are bound together by valuation sensitivity. by leverage, by interconnection, and then there's this fault line where an energy shock meets a slower technological shift, which is a bit of a known unknown maybe. I think the system is holding up. Resilience is real, but it's being asked to absorb shocks of a kind that it has not been tested against in this combination before. I mean, we're rarely doing financial stability assessments with more than, it's usually one shock that we're looking at. So anyway, with that, I think I and the team, the ECB team, are looking forward to hearing what Fabio and Katja might have to say on all of this. Thanks a lot.
Thank you very much, John, for taking us through the main findings of the FSR. I'll pass the floor to Fabio in a second. I just want to remind everybody online, if you have any questions, please post them. There's already one very good question, but I guess there may well be others. So on that, floor is yours, Fabio.
Thank you for inviting me. It's always a pleasure to be here, and it's always fun to comment on John's work. He always does great work in terms of analytical rigor, but also thinking about the big picture. So it's a real pleasure to be here. I'm going to try to frame it in a slightly different way, looking more at those two forces, essentially the geoeconomics and geopolitical aspect, and the AI, but more from a structural perspective. So beyond the cyclical impact that they may have over the next months or quarters. In particular, the geoeconomics, what are the implications in terms of financial fragmentation? Financial fragmentation in terms of what it means for inflation and what it means for example, fiscal spending, when we think about building resiliency across the energy supply chain. And I think that's a little bit what the global sell-off in yields has been telling us, a mix of a bunch of these things: inflation uncertainty, fiscal concern, a lot of those. Some of it has receded at this point. For example, on US rates, 30-year reached 5.2, now it's back to 5. The 10-year is down to close to 4.5. But I think the story still holds. And the second piece then, it's AI boom, right? What it means in terms of adoption and disruption, benefits, but also risk, particularly from a financing standpoint. So the first point is about this financial fragmentation issue. I think we are facing a regime change. I think the way we know globalization, or we have known globalization for decades, that order, the new world order means the end of globalization as we have known it. We see this again in the push to spend defense across the globe at this point, across the advanced economies, the push to spend money on supply chain resiliencies. All of this means moving away from efficiencies, which was the driver during globalization and just in time, to resiliency at this point. So just in case, all the issues about inventory management, hoarding during distress, and all of this has implication for fiscal spending, and therefore for long-term interest rates, and then also for inflation. And so ECB being a central bank, that's part of the big mandate. I think markets have never been good at this. Markets are very good at extrapolating what they know well in a linear way toward the future. They've never been very good at picking up timing or extent of inflections. So discontinuities, non-linearities, they've never been famous for being great at that. In my view, we are in one of those points in terms of regime change. We see fragmentation and friction everywhere. You can look at oil, look at the spread between Brent and WTI. You can look along the refining stack of oil, from diesel to jet fuel to gasoline versus crude oil. You see in the LNG, you see in fertilizer, helium. There's a long list of where you can look at this fragmentation. Some of it may go away. Eventually, the war hopefully will end. The Strait of Hormuz may or may not reopen. There might be different alternative path for oil. But my view is that some of those friction and fragmentation will remain, and they will come at a cost. And I think we need to deal with this weaponization of choke points, whether this is AI and how US has used it, whether this is about rare earths like China is using, whether this is oil like Iran is using now. Countries will learn how to weaponize this choke point. And those have huge implications, I think, in terms of efficiency and in terms of cost, in terms of inflation. The second piece is the AI boom. I think there's a discussion what are the short-term versus the medium-term impact in terms of inflation. I think in the short term, my view is that this is going to be inflationary, combined with the fact that we're facing a fourth supply shock in a row from COVID, the Ukraine invasion, the tariffs, and now we have this. I think the question, it's one natural question, is how consumer and firm we're going to start internalizing this. Right? We spend so much time discussing the anchoring on long-term inflation expectation, and having worked at the Fed, I'm very sympathetic to that, looking at the five-year forward. The problem is now this is, again, a serious supply shock that is going to affect the structure of the economy. I don't think I recall a time when five-year forward ever moved. So I'm not sure how much comfort should I take from that. If you look at the 5-year tips in the US, for example, I'm a little bit discomforted with the fact that that actually has moved 20, 30 basis points until a few years ago. 5 years is not short term. 5 years for planning purposes of corporation and firms is the medium long term. So I think we need to spend more time looking at those. And then the third point, John hasn't covered this, but I think it's worth throwing, how digital finance is going to fit into all of this, right? Stablecoins, CBDCs, they will become a tool in this new geopolitical warfare. And so can, for example, the euro becomes the player in this new world, or will remain relegated to the side, to the sideline? And so for John, I have two questions to consider. I'm going to close. One is how to interpret asset prices at this point when you live in this world of nothing uncertainty, right? The cone of outcome is extremely wide, and it's extremely challenging to assign probability to those. So how should I read asset prices? It's a challenge that I think we're all facing, but I think we need to think a little bit differently than we use in the past. What information is coming out of asset prices? That is how banks officially in the new world, particularly not just the ECB, all central banks. Despite all my story about fragmentation, I think global financial markets are still a source of transmission of spillovers. Think about the exposure, John mentioned this, of European equities to the US, right? The US account for like 70% of global equity indices, 30% is AI. So whether you like it or not, you are exposed to AI. And so whatever happens with AI, the cost of financing and the valuations, right? It's not just the numerator, the earnings, whether those earnings are going to be able to backstop the massive capital investment, but also interest rates, right? The discount factor. The combination of those two is going to determine whether this is going to be how this productivity boom is going to play out. The other aspect, which I think it's not discussed often, it's not just a matter of the time frame when this productivity boom will realize, and whether the time frame is different than what markets are pricing now. I think the market structure where this productivity will eventually materialize is going to be crucial, meaning whether we are in an oligopolistics world where the Google of this world are going to accrue all the benefits, or we're going to be in a much more competitive world. And that's the scenario that would generate these inflationary forces. It's not obvious to me that we are heading in that direction, even if the timing is what financial markets have in mind. So you might end up, you pick up the right timing, but the endpoint is not the same because you don't get this inflation because of the lack of competitive pressure. And then the last point, and then I'll end, it is what is, and this is always the big question, what is the role of Europe in all of this, right? What is the impact of all these structural forces on European financial markets, European inflation, European growth? We know that Europe needs to spend more on defense, on energy resiliency. That means inflationary pressure, longer-term interest rate going up. Maybe this is the opportunity, is the trigger for a scaling up in the Eurobond market. There's a lot of estimates out there of something that could be meaningful. And then for now, though, I think the sad reality is that on the AI ecosystem, Europe still remains in some sort of bystander. If you look at the AI stack, you can come up with very few European firms that actually play a role in that stack. And so deep capital markets, but not capital markets in general. You need risk capital markets. You need venture capital. You need private equity. You need equity. You can't fund the technology boom through debt. You need equity, and that's a much more complicated thing to do. I think, and I end here, if that's not going to happen, if Europe doesn't accelerate and use this window to push for deeper capital markets, risk capital markets, I think the issue is that it's going to remain exposed to geopolitical forces, and it's going to suffer from a growth standpoint. And my personal view is that without growth, you can't have financial stability, no matter how resilient the system is. And I'll stop here.
Thank you very much, Fabio, for very interesting and I think very complementary points to what John said. So last speaker before we go to questions, and now we have a couple of questions already, but still more are always welcome, is Katja. So if you could also keep it to around 10 minutes, and I think Dragana will share the slides. Thank you.
Okay, thanks a lot, and thanks for inviting me. Yeah, I did prepare some slides with some observations, and thanks for John for presenting the FSR. I think that especially in this time, it's hard to choose what are the main risks because there are plenty to choose from. But I think that you have indeed managed very well. So the FSR clearly identifies the key risks. You mentioned the main risks, and I think that they are the right ones, sort of. And also the banking sector has been this time part of the solution, not part of the problem. But of course, like you mentioned, there are credit, liquidity, and funding vulnerabilities that might come later in this cycle. But thinking about the main risks, I think one of the key observations is that they all are pretty much interlinked and intertwined. And they are especially vulnerable to the lower expected growth and higher inflation. So if we end up with the stagflation and stagflation pressures, I think that those are very dangerous for all these risk features that you mentioned before. We can go to the next slide. So the key might be the duration of the geoeconomic shock, which is a crucial factor. In the spring, I actually remember that the ESRB and ECB published a very good report about the geopolitical risks and their impact and main impact channels and main impacts. And I think that it's very important to remember what was mentioned in that report, because it said that usually when we confront these geopolitical risks, they do dampen the global output. They raise the consumer prices and shipping costs due to the strained supply chain. They do erode business confidence and reduce global international trade. They increase the volatility across asset classes and reduce stock prices. And they do widen credit spreads and lower credit to the private and non-financial sector. And if we try to reflect these findings and then compare the risks that we all are vulnerable at the very point, there are certain similarities. So I think that we should keep an eye on where we actually are going with all these left side figures. So thinking about the key vulnerabilities, it seems that the asset prices don't currently price in the possibility of slowing growth or stagnating economic growth. I think you mentioned it as well. Then the euro area, like said, it's fragmented in many different ways. We are in different financial cycle phases. We know that we have different kind of factors that do affect the fragmentation. And one of those is related to the fixation of the interest rate. So we know that in Europe, we are in different regimes related to how the fixation is done in the interest rate in the loans. So either we are in the fixed or variable rate regime. And of course, that affects greatly to the transmission of interest rates. And especially if the economic growth slows and the interest rates go up, the level of the indebtedness in all the sectors either it's households or companies, it becomes a key question. And then you mentioned this one as well. So related to the sovereign debt, we usually in the crisis situations, we try to rely on public help, but especially if we think about the European situation, the sovereign debt levels are high, and the good question is that is there actually a reduced capacity to support sectors in crisis if needed? So we can go forward. And the other one is the trust. We all know that the finance is actually a trust business. And in current framework, there are actually many features that can impact the trust in the system and rubble it. So the possible triggers for untrust to build up, they can come from interlinkages. We know that interconnections and interlinkages are the key features of becoming systemic in a sense. And lack of transparency, like we have seen many times before in crisis situations, that one of the key aspects that can really quickly build up the great untrust and freeze the system. And one of the key questions relates to the private credit. And for example, the non-banking sector, we don't know enough about the interlinkages, interconnections, and especially in a very hard situation like you showed your simulations, it really creates a risk of accumulation. Operative risks, that's one of the things that we usually did look a little bit separately. So financial stability and then operational risks and infrastructure. But the cyber risks related to the AI, they are becoming more and more important. And I think that we can't look them separately. And if anything bad happens in the infra or in the operative risks, it clearly has an impact to the trust as well. The energy prices and energy related sectors, they are important because we know that interest rates, they do have an impact to the indebted sectors. But if energy prices go up, they do have a very wide impact in the economy. And of course, during periods of stress, liquidity is always the king. And the funding conditions become critical factors. And especially if we think about Europe, asset market corrections could trigger investor outflows from Europe. The banking sector is strong, but is it actually able to provide funding if the demand is increasing greatly? And if the market-based funding channels weaken? And then the question is, who is actually crowded out? Is it the weaker or is it the riskier companies? And then we can go to the last slide. So here are a couple of features that I thought that if we're taking a little bit longer term view, which could be some of the things that we need to understand a little bit better. And like you see, there are a lot of AI and a lot of cyber. So especially the AI, clearly there are a change in the structures going on. This relates also to the financial sector. And there is a creation of winners and losers going on. And winners, how they are picked up, it depends completely their ability to invest, which is critical. Then the AI and cyber. Interlinkages and networks are becoming more and more important in systemic sense. So like I mentioned, we need to understand the operational and stability risks because they are strongly interlinked. Pace of actions is increasing in digitalized environment, and this challenges us as the central banks. Then the simplification and deregulation. We need the simplification, but not deregulation. And especially if we think about this time where we now are, The deregulation is creating potential threat to stability. It also increases the lack of transparency as the new risks are emerging. And we need transparency, especially in that field. And then Europe needs economic growth and investments, and the investment needs are large. So in AI, defense, sustainable growth, and so on. And the sovereign debt remaining at high levels creates clearly challenges. And that's why I agree with the previous speaker. So we need to create deep capital markets, which also could attract international investments. And then finally, energy transformation and climate. I think that there is need to increase the use of sustainable sources of energy. Thanks. That's all.
Thank you very much, Katja, for also very interesting thoughts. So we had in the meantime a couple of questions. Let me start with the first question that came in. I think is an interesting one. It's probably mostly for Fabio and for John. So this is when referring to market resilience, is it justified to assume that high corporate earnings expectations in the US are improving risk sentiment globally, not just in the US, across asset classes and also in euro area markets? So is it fair to say that the AI story is buffering markets from the impact of other risks that were discussed today? And then, of course, the question as well, what if the AI story becomes more seriously challenged? So maybe Fabio, do you want to start with this, given that it's very close?
Sure. I think in the end, what you see in markets in the last few months now, it's a tug of war between two stories, right? The geopolitics versus AI. And you can see, particularly in the correlation between rates and equities, that seems to be changing based on days and news. I think in a more integrated financial markets, I think the ability of the US outperformance to work as a magnet, essentially, and to bring along global markets, that ability will be diminished going forward. And you have seen 2 days of outperformance to US equities, and then starting with Liberation Day last year, the outperformance is starting to shrink, which means that I think more specific fundamental driven factors will be increasingly important in telling a story what the performance of relative risk asset classes across geography will do. Mm. That said, AI remains an important global driver of market sentiment, and that remains primarily a US story at this point. And so I think it will continue to operate that way. My only point is that it's going to be, I think, less effective than it used to be in the past. There's going to be a geographical differentiation that is going to be a function of which countries are a player in that AI stack that I was mentioning before. So there are some Asian countries, South Korea, Japan, that they are player in that stack, that they have a specific irreplaceable role now in that stack.
Thank you, Fabio.
John. Fabio and Katja have really lived up to expectations. I mean, really, really great points. I mean, when I just kind of try to put it all together, I mean, I think some what you're saying is that we need to think about horizons. I mean, we're doing every 6 months a financial stability review, but we need to be thinking 5, 10. We are at this inflection point. I think that Fabio nicely described it as supply shocks. Yeah, Katja, you had this slide with the title. What did it say on it? The duration of the geo-economic shock, and I'm asking myself, which one do you mean? Because I think Fabio mentioned 4, and I think this is becoming a bit the new norm. And I think Fabio made a very important point about supply side vulnerabilities and geopolitics and the ability to leverage in different in different parts of different supply chains. I mean, there's a book recommendation that I recommend many Europe to understand why we have been more observers on everything. It's called Chip War. It describes the whole history of the the semiconductor industry, where Europe has been kind of always absent there, with the exception of this Dutch company that makes these 200 billion euro machines that actually chips couldn't be made without. But when you think about all of the things, you know, supply chain choke points. Okay, so we're looking at energy, but you know, you've also got rare earths. You've got semiconductors, which that book is all about. Then now, I mean, for me, a friend of mine asked me recently, and this is where I might challenge a bit that Europe is not a participant in AI. A friend of mine asked me recently, I mean, I like to use all the models. I mean, I like using the AI models, and my friend asked me, how much would you be prepared to pay for those models? Because you have, you know, learned how to extract value for yourself out of that. I mean, and I think I'm getting more value out of them than I pay for them, and I'm paying top tier. What I saw with this, you know, there's been a lot of discussion about this mythos. I don't want to get into the, because I'm not an expert on this model, and I don't really, you know, I don't want to say something that I wouldn't be correct about. But I think one observation that I've made from all of that, that's another demonstration of potential strategic supply, what would I call it? Opportunism. Yeah, and I'm just so and if I just want to develop the point a little bit further, Fabio, where I would challenge Fabio a bit, I think Europe has benefited from the consumer perspective from AI. And so in a way, we're getting cheap AI services without having had to do much of the investment. What I would worry about is that because we don't have AI firms that can produce that AI, the day might come where European access to those models would be choked off, and then, you know, that's another supply shock kind of thing, and you know, then it's you know, then we have something to worry about. You were asking about how to interpret recent asset price developments. I mean, look, I fully agree with you. I mean, look at some of the firms, you know. I mean, I thought that they were massively overvalued. You know, some of the firms in the semiconductor business, let's say, the firms that are really benefiting. I mean, you just look at their earnings. I saw something on my either yesterday or today on my social media showing, you know, comparison of NVIDIA earnings to Cisco earnings, and you know, this is a bubble. This is not. The graph is very convincing. You know, you can value these companies. I think what people have always been worried about are what people. And as you were mentioning a point about competition and monopoly, Fabio, and you know, this is like, you know, I think some people didn't believe the hyperscalers in the US could continue growing because they had reached such a large size. And I think there's work, Montpesson and others have shown the larger companies get the growth rate start to decline. This is not happening with the hyperscalers because their market has changed. It's no longer US only, it's planet Earth. And you know, and they can continue at very high growth rates for a long period of time. So I mean, I've had to do myself a bit of mea culpa on, you know, showing, you know, these stocks are, you know, there's overvaluation here. I mean, I'm kind of less sure than I would have been in the past. And I think there is this element that I hear a lot from market participants about this kind of, you know, especially in this geopolitical world, supply shocks and so on, the difficulty of valuing assets when you have binary outcomes. It's difficult for pricing. It's difficult for risk management as well. You know, and it's when you can't measure the probabilities, it becomes very difficult. So, you know, the best we can say now is that, yeah, we think valuations are stretched and vulnerable to correction, but I don't think it's you know, it's broad based. Actually, you know, when I was looking at some of the comparisons of high tech stocks in the US not long ago, comparing to the rest of the economy, the rest of the stock market, it actually looked like there was the rest of the stock market that was overvalued, not the tech.
So this is directed to you, John, but I think others also have views on this. It's about EA sovereign spread. So what seems more notable at this point is the rising level of the overall rate level, and of course this is related to, you know, growing indebtedness and the lack of fiscal space. So what's your view on whether banks and NBFIs are prepared for further rising bond yields if inflation and rate expectations were to rise further?
I mean, maybe just on this point, and you've linked banks and sovereigns. I mean, I think this is really important to understand what's happening with sovereign debt pricing in Europe compared to, 10, 15 years ago, Reiner, when you and I were involved in, with colleagues in the IMF doing Troika financial assistance programs. We don't, and this is part of the whole, resilience of the banking sector. We don't have a banking sector that sovereigns have to worry about in the same way. So, I mean, I think sovereign spreads are behaving better because we have stronger banks today than we had 15 years ago. And I think that's a first order. That's a first order improvement. Then, we've had these big, notable shift in, the South has improved a lot, and the North, is maybe not as much. And so, there's a bit of, a need to look behind. But we know also that there are several additional structural pressures on fiscal defense spending. Is it's become necessary, and there are others. Yeah, I mean, this would be a topic on its own, but I mean, I feel much more comfortable about that the sovereign bank nexus than was the case then, and what that's the financial sector that has gotten its act together, not the fiscal sector.
Okay. Katja, Fabio, any comments on that?
No, not particularly. I mean, on the sovereign piece, I think there's a lot of improvements have been made since 2010 in terms of the banking sector, in terms of the sovereign approach to this. My concern, the reason I raised that issue was not because I was concerned in a backward-looking way, if you want. I was concerned more than all this call for resiliencies will be adding to fiscal expenditure and to whatever the level of debt is already at the time when everyone else is doing. So when you issue more public debt, you're competing effectively with countries in Asia, with the US. If you go down the fiscal outlook in the US, you go down a rabbit hole in terms of sustainability. So there's going to be a lot of competing issuers, if you want. And I think that was my concern. It's more a forward-looking aspect than a backward-looking piece. Okay. But I agree with the vulnerability from that sovereign bank channel of transmission. Those have been at least ameliorated.
Okay. Great. We're coming to the end, but Katja, anything you would still like to comment on of the questions? Or?
No, I could actually agree with what Fabio said. So I think that it's important to look a little bit more forward, because the case is that we do need a lot of investments. And of course, the situation in the sovereign side is rather stretched at the moment. So it's a puzzle. Yeah.
Let's close here. Thank you very much indeed. I think this was extremely interesting. To all of you, have a nice afternoon, evening, and a good day to you, Fabio. You're a little bit ahead.
Thanks again.
Thanks a lot.
Thank you.
All the best. Bye-bye.
Thank you. Bye.